welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Now, we all know that inflation eats away a part of your hard-earned returns. But did you realize that actual lifestyle inflation is much, much higher than the consumer price index increase that's always in the headlines? In fact, going by some estimates, inflation that's impacting HNIs or the affluent urban Indian is as high as 12%. So this week we asked the question, is it really possible to create an inflation-proof portfolio? And if yes, then how do we go about creating it? Well, joining me to answer that is Feroze Azeez, Deputy CEO of Anand Rathi Private Wealth. Feroze, always a pleasure to have you on the show. It's good to have you back. So, your sense first on this whole inflation conundrum, because whenever wealth managers like yourselves are advising clients as to where to put their money, you always take inflation into account, right?
Absolutely. See, I think the first baby step of investing is inflation, because if you don't store your money efficiently enough that it grows more than the commodity you wish to buy, you're better off spending the money rather than storing it and then buying stuff later. So inflation becomes the first baby step of investing. So you can't go wrong with the estimate. So that's where we started deliberating whether the high-frequency CPI, which comes on a very regular basis, is that relevant, and what is the consumption pattern the government assumes, and is that a right assumption? And then we were surprised that it was incorrect.
So what are your own numbers telling you, the mathematics that you've done, and what is the figure that you've arrived at?
So when we did a large piece of information gathering, we realized that 12.13% is what came as inflation, depending on what individuals spend on. Of course, it can range between 11 to 13, but it's significantly upwards of at least the double-digit number.
So how do you get to this number of 12%?
So what we did was we tried to understand people's spending patterns in urban India, like you said, or an HNI, high net worth individual. What do they spend on? And then we made a list of 10, 12 items which they spend on, like brands, like club memberships, by air travel, banquets for their child's wedding, could be higher education, sophisticated medical care, because that's also inflating at 16-17%. So if you put equal weightage, assuming that an individual spends on these a reasonable amount of money, then that's how we arrived at a 12.13%.
So now we come down to the tricky question that yes, everybody wants an inflation-proof portfolio, and it's perhaps easy to say that go invest in equity because equity over a long period will give you better return. But I guess the critical question is the right mix. At what age, at what sort of profile do I need how much equity, how much debt? So maybe we can classify this for the young investors, the middle-aged investors, and then for the more sort of senior investors. How do you create this portfolio?
See, I think, if age is going to be one large determinant of how you're going to allocate between risky and non-risky asset classes. First, it's very important to understand that there are two risky assets, or growth assets as we could call them on a positive note. That's equity and real estate are the two growth assets. And
is real estate still growth?
Yeah, probably
After the last few years?
Yeah. At least looking at the contemporary situation, it's not growth, it's degrowth maybe. But yeah, from a characteristics perspective of the asset class, it is a growth asset. And on the safety or protection is debt and gold. So I think a person who's at the age of 30 should at least have 70 to 80% of his money in growth assets, real estate and equity. Looking at the current situation, largely skewed towards equity and not skewed towards real estate. And the other 20-30% could be in protection assets, which is debt and gold, to my mind. And as you progress every five years, you could probably reduce your risk assets portion by about 5% and move that into protection as a thumb rule. I think that's a good way of mechanically managing your money rather than rediscovering this question more or less. So at the age of 30, you start with 80 and 20 and then move down 1% every year. Maybe in the pockets of every 5 years, you could bring down your risk assets by 5%. So by the end of getting to 50, you would have brought down your equity allocation to almost about 50-55.
It's interesting, we're speaking at a time when equity markets are back to their historic levels, historic highs. So does this thumb rule work even now in the current market situation where we've already seen such a big rally?
See, I personally think over long periods of time, you want your equities to give you large portions of return. 10-15% this way, that way as a start point will not change your return per annum over long periods of time. So if you actually put some number, if you would have let go of 10% rally, for example, which has happened over the last couple of months, your return on a 10-year basis will change by 0.3%.
Okay.
Now, so for a short-term investor, it's very relevant to actually see where we are entering. But for a long-term investor, especially when he's doing his life's planning and goals, I think on a per annum basis, the IRRs wouldn't change too much, or the return per annum wouldn't change too much.
Okay. All right. We'll take a break on that note. On the other side, we get down to specifics and get down to actual equity breakdown. If you're looking at mutual funds or vis-a-vis direct equity exposure, what are the funds that you need to have in your portfolio to make it inflation-proof? Back after the break. Welcome back. Here with Money, 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 and this week we are discussing how to create an inflation-proof portfolio. We've got Feroze Azeez of Anand Rathi with us. Feroze, so let's get down to the basics. I mean, do explain the concept of a real portfolio return to us vis-a-vis a nominal return, which I guess sort of doesn't take inflation in account.
Absolutely. I think the concept of nominal real return is very, very important. See, real return is the return you make over and above the inflation. And especially in a country like India, where inflation is very high, producing real returns becomes an uphill task. So if you are not taking the risk, then the risk itself, not taking the risk becomes the risk itself, because the commodity is growing at a far larger pace than in the global situation.
What sort of funds would you then advise which will give you a return in excess of 10%, because it has to be 10% plus return for it to be inflation-proof?
See, historically we've seen there are several categories, at least in the funds, mutual fund space, which are not relevant. Okay, so an individual investor who has a very simple objective of beating inflation and creating some degree of real return, is not a very complex objective, should look at simpler products and simpler categories. So I would say only 3 equity fund categories out of the 7, 8 are relevant to a person, and he needs to cut out the noise and focus on these 3.
Which are these 3? These
3 are large cap funds, mid cap funds, and multi-cap funds. A large cap fund is one which invests in large companies, as the nomenclature suggests, and mid-cap invests in mid-cap companies. And the ones which are opportunist funds or multi-cap funds, which can invest in any sized companies with a different mix of mid and small and large kind of companies. So these are the only 3 funds categories should he focus on. So brings down the universe to 1/3. Now you're looking at only 1/3 the universe to pick from, and becomes a simpler job. To answer your question, these are the 3 categories you should focus on.
What's your take on hybrid funds? Because if you're looking at a portfolio, sort of allocation between debt and equity, do you prefer hybrid funds which automatically give you a debt element as well? Or is it better to do a pure equity fund and then add a pure debt fund and then balance out your portfolio?
See, there are 2 things. If an individual is deciding the asset allocation, how much is he putting in debt and how much is he putting in equity by himself, if he is not outsourcing this decision, he should not have a balanced fund. If he says, I am not even capable of trying to decide how much in equity, how much in debt, let me outsource this decision to the fund manager, then he needs to choose a balanced fund. I personally think this is a very individual decision of how much in equity, how much in debt, which is very specific to what goals and what age you are at. So not outsourcing it or delegating it to the fund manager would be a wiser thing to do.
Okay, so then let's get some examples of the funds that you like. If we're talking about pure equity funds in 3 categories as you described, mid, small and multi-cap, which are the best products that you think are out there in the market?
So before we get to how many products is also a very important aspect. I see a lot of people whom I meet, they have 10, 12, 15 products in the equity category over periods of time when they've accumulated with different interactions. So I personally think there's statistical proof available that having more than 7 funds is over diversification, and you get into the risk of over diversification. So first point, have not more than 5 to 7 funds. And in that, at any point in time, you have to make sure that it always stays there. And in the large cap category, I would recommend an SBI blue chip fund. And you can look at a ICICI focused blue chip fund. These are the 2 funds which follow different styles and will complement each other.
Okay, when you say different styles, in what way?
See, the different styles would be some fund manager would be accustomed to go along the tide and go with the growth momentum. There'll be some fund managers who are more contrarian and go the value way and pick up those stocks which are not in favor today but are expected to be in favor later. So they both follow, one follows a growth philosophy, one follows a value philosophy.
It's a good idea to perhaps have both the funds, because you can benefit from both sort of philosophies depending on what's working in the market at that given point.
Absolutely, absolutely. So you're having complementary complementary products rather than contradictory ones.
Sure.
Right? So then move on to the mid-cap space. If you can choose two funds, HDFC mid-cap, and on the mid-cap category, you can also look at our ICICI Value Discovery Fund. So these two mid-cap funds, again, have a little different philosophy and don't have too much intersection in the portfolio between these two.
So what is the difference in philosophy here, just to understand?
See, I'll tell you. In the mid-cap space, there could be two philosophies. Either pick the sector first, which is called top-down, pick the stock first, which is called bottom-up.
Right.
So one of them follows, fix the sector first and then the stocks. Some pick the stocks first and the sector second. So both of them follow a different
again, you have the benefit of both complementing each other and hopefully sort of averaging out the returns. Then we come to multi-cap. What do you like here? Because here the risk element is also sort of progressively increasing a little bit, I'm guessing.
Correct. Here I have a little contrary fund. It's called the Reliance Equity Opportunities Fund. It has not done too well over the last 1.5 to 2 years, but to my mind it is at the trough of its performance, and I think there'll be a huge performance which it'll revive out of. So I think Reliance Equity Opportunities will be a very good fund at this point in time to pick up. Not just from a past performance perspective, from a future prospect perspective, this would be a good mix. So if one buys these 5 funds together, he will automatically own 150 to 200 stocks inherently by buying these 5 funds, and that's a good diversified, well-oiled machinery for you to deliver inflation.
So these funds put together or individually, even depending on what sort of mix an individual goes for, they take care of the equity part of the portfolio. Now, what about the safety part of it? Keeping in mind our goal, which is to create an inflation-protected portfolio.
Correct. I think again, like you said, debt goes hand in hand with inflation. But I think interest rates have not fallen as much as they could have. So it's an opportunity for one who's building his portfolio, right? If interest rates would have come down, he would get lower returns on his debt portion, which would make the pressure on the equity far more to deliver above inflation numbers. So one should actually build his debt portfolio from locking in the interest for as long as possible. So in that category, I'll recommend 2 funds. There's one fund which locks in the interest for as much as 3 to 4 years, which is called the Franklin Templeton Dynamic Accrual Fund, which would be one of the best funds in the next couple of years to come. And then you can look at an ICICI regular savings fund. These 2 debt funds could complement and bring in some stability and help you weather the turmoil of equity whenever there is some kind of correction and stuff.
And both are types of accrual funds?
Yeah, both are accrual funds, yeah.
Okay. Is there place for gold in the portfolio as well, with our overall target of keeping it inflation protected?
See, what happens is I personally think gold automatically, by the virtue of jewelry and stuff, you automatically own 3 to 5%, 10% of your wealth. It depends on the individual. If you are completely underexposed, having 8-10% of gold, including the jewelry, if you count that in, then I think anything above that will be underutilizing your funds significantly.
So, okay, we've got some ideas, Feroze. If you could recap for the benefit of our viewers the steps towards creating this ideal inflation-protected portfolio.
Yes, I think there are 3 to 4 steps. The first step is deciding the asset allocation. If you got your asset allocation incorrect, then beating inflation would be an uphill task. So having a large portion, depending on your age, starting with 80% towards growth assets at the age of 30 and reducing it 5% for every 5 years of life would be a good asset allocation to choose from a thumb rule perspective. Then coming to the choice of vehicle to help you beat it. That's using mutual funds would be a very, very important aspect of beating inflation. So in that category, if you look at large cap, mid cap and small cap, 3 categories, and not have more than 5 funds. I think those 5 funds which we discussed would be a good mix of mutual funds. And the third is to make sure that you always monitor whether you're going towards your goal of meeting inflation or not. So that becomes a very important monitoring tool. You can individually monitor each scheme, or you have to monitor your portfolio whether it's growing at 10 to 12% or not. If it is not, then you will have to relook at your strategy 1 year, 2 years from now. All
right, we'll take a quick break on that note. On the other side, we've got some viewer queries on mutual funds. We'll come back and answer them.